Welcome everyone to another episode of the Traders Roundtable. My name is Jitan Solanki. I'm going to be your host here today, and I've got three fine gentlemen joining me here today as well. So we have Paul Wallace in the house, Marcus Habel, and Jens Klatt. Guys, it's a pleasure to see you after a while. So it's great to see you're in fine form and you're here, and hopefully you guys have been keeping well.
Good for me, Jitan.
Good to hear. Good to hear. All right. So where do we begin, right? There's a lot of different things we could be talking about today. I mean, just again, I think every time we speak, there's something historic has happened, right? It's just the year of making history, isn't it? So right now, obviously, a lot of traders and investors, they will be thinking about where to put their money, what markets are going to be moving over the next few months. Now that all these different countries are coming out of the lockdown period and businesses are reopening and trying to get the economy running again. But today we're really going to highlight or speak about the UK markets, because we're in an interesting, I would say, conundrum, right? Because not only are they looking to reopen businesses and get the economy rolling again, but we are also right at the beginning, really, of Brexit negotiations, which aren't really going very well, if we are to believe the headlines that we see, at least here in the UK. We'll hear about what you guys hear about in Europe, if anything at all. I know you've got your own issues over there right now, which we'll get into a little bit later on. But so I just really want to start off with just some of the pressures that are on the UK markets right now with the UK government, some of the key things that traders and investors are focusing on now. I mean, we've got the most important thing out the way. The pubs have reopened, bars have reopened, right? I don't know what it's like in Europe, but in the UK, every paper is, every paper, the front page is like, the pubs have opened. It's like a real milestone here. My wife, who's Dutch, she's just like, why? It's just, this will not happen in Holland. But so look, we've got the most important thing out of the way. Pubs are reopened. People are out and about. But what are the biggest risks facing the UK markets? And Paul, I'm going to ask you this question, because I know you're up north looking down at us southerners down here. So you've got a good high level overview from the north of England in terms of what we're doing down here in the south of England. So over to you, Paul. What's going on in the UK right now?
That's a great question, Jitan. How long have we got? Because that, as you sort of said in your intro, we're at a really very weird time at the moment. But I suspect most people understand and know that. The question is, we're at this moment, we are coming out of lockdown in our phase way, and I suppose as we look at it as traders and as people in just working in the economy, people are starting to think about, well, do I have a job to go back to? Is there, there's been a lot of people here. Was it 9 million people put on furlough in the UK? The number might be or less, but there's 9 million people, let's say, that were put on furlough in the UK. And the question now is going to be as we come out of lockdown, as we rise, have those people really got jobs to go to? Is the economy coming back? The numbers have been pretty horrific, but equally everybody expected those numbers to be bad. And so, of course, invariably that is going to weigh on both, individual stocks in the UK and also, the FTSE and sterling as well. And that's before we even touch on any of the elements with regards to Brexit. I think that it's just going to be a case of, personally, for this month, I'd say I suspect people are just going to be basically taking it day by day, trying to see how the markets open up again, how economies open up, and whether there is really demand there. Whether there is demand there, whether people are going to go out and spend money, however that might be, or whether everybody's going to be sandbagging the money. Okay, and I think regardless of what Mr. Sunak does tomorrow in the UK, our Chancellor, with his commentary, which we can speak about in a bit, it's a case of, is that going to be enough to stimulate any kind of drop in demand that comes just from the average consumer? And so it is a little bit of a wait and see at the moment. It's all a little bit, I think, a little bit on the knife edge at the moment, Jitan.
Yeah. And I think it's all around the world is pretty much similar, isn't it? It's just too much uncertainty to obviously predict, but of course it's just about knowing some of the risks that are out there, right? And when things start to align. I mean, in terms of Brexit is obviously. What do you think people are going to be focused more on right now? I mean, the economic numbers, or is that just like a given? You know what? Eventually people are going to be spending money, they are going to be just going out. It's just a given, right? We've seen that across the world. Investors are like, you know what, it's going to sort itself out. So do you think the shift is going to be more on like, okay, there's a real potential here for no deal Brexit at the end of the year? Do you think we're there yet, or is it still a bit early?
I'd say it's still a bit early to call that myself in terms of the deal. I suspect that that these last 3 to 6 months have had a huge impact across countries, UK, Europe, globally. So I would hope that would actually be enough. You would hope that would be enough to actually to allow rational heads to sort of rule, and actually people to get around a table and do a deal of some sort, because everybody's going to be hurting. It's in nobody's interest to hurt someone else more so than themselves. And I think I think that you would like to hope that rational heads would prevail, but politicians are not always rational, are they? In the way they act and stuff. But I think that it is going to have it will have an impact, Brexit. But I think that will only come out over the next month or two. I think certainly for these next few weeks, I think people are just going to be looking at how is the economy. Is there this second wave emerging? But I think people will just focus on the economy. They know the numbers are going to be rubbish. When the numbers come out and the rubbish, nobody's really shocked by that. It's more about what is the ability for it to bounce back? How quickly could it bounce back? And is there even a hint of it coming back? And if so, how fast will it do?
Yeah, so it'll be interesting, and we'll look at what's been happening with UK markets like pound in a moment. But I think it'll be good just to get the other side of the story over in Europe. And Jens, I'll speak to you about this one. Do you guys even care right now what's happening with Brexit? Is it even a concern, or you guys seem to have some tensions brewing, right, regarding this coronavirus recovery fund? Some countries are like, no, we don't want to help you. Well, not give you free money. Okay, we want to give you free money. So, are you guys even focused about Brexit right now, or is it just there's too many other things going on in those 27 member states?
So in fact, Brexit is not a very intensively discussed topic here in Germany, but I think it was last week or so that Chancellor Merkel said something in direction to prepare for a no-deal Brexit, So I mean, to be honest, I'm not really sure whether she's serious about this because of the importance of the UK for the European economy in general, also for Germany. I think the UK is the second largest. It's the second largest, I think, trading partner after the US, I think, and especially now with the coronavirus hitting us, I think the situation is, I don't see us in a very strong position, to be honest. I think it was today that the European Commission said something in direction that should be expected that we see a contraction by 8.7% in the Eurozone of the GDP.
Forecast, yeah.
Yeah, and that was significantly deeper than the 7.7%, I think, which was predicted in May. And I think even that is too optimistic. And I think this whole talk about a V-shaped recovery, I don't see it, to be honest. I don't see a V-shaped recovery. I I'd be happy if we see a recovery at all. I think the next 3 to 5 years could be a very, very rough part. And I remember last time when we had our traders roundtable, I was very positive for the UK, and I stay positive for the UK because I think the UK is more flexible right now, in a very flexible position. I think given the potential for especially small and mid-sized companies, I think the UK is in a very, very favorable position here, given all the bureaucracy in the European Union. And if I look at this, I have to say that even though currently we all may face difficulties, the UK potentially, or has the potential to get out of this in a more dynamic way and take on a more bullish momentum, let's say, in terms of economic growth in the European Union, especially given all these troubles right now with the uncertainties around the corona help and the potential fiscal stimulus. And I think also when we saw that was very interesting to see in the morning. There was a clear connection between the headline of the GDP reduction, or the negativeness about this statement, and the DAX dropping. Because right now I had at least the feeling that bad news is good news for equities, because it means more stimulus. But if I see a direct negative reaction at equities, it somehow makes the impression that this more negative forecast for the GDP growth is directly connected to right now it's not enough stimulus. Or not enough money, which is given away from the ECB, but not only from the ECB, but also from a fiscal perspective. And if I look at this and see all the current tensions brewing, I have to say I think that it doesn't look very promising. Let's say for Europe. Let's put it that way.
Well, let's hear from another German perspective, right? I mean.
Oh, he's Bavarian, by the way, so a German is a little difficult.
That's a little bit difficult.
Well, look, Marcus, I mean, on that note, look, obviously traders out there right now, investors out there right now, they're trying to search for the next opportunity, right? They've got all these different headline figures coming at them. This news is bad, but there's some good news over here, but this is bad news over here, but this could be good news over there. I mean, from your perspective, how would you, how should traders and investors be even digesting this information? I mean, how would you be managing, how would you be trading right now with all these different things coming at you, and also a bit more range-based markets that we have been finding, because there is no economy in the currency market, with how currencies move. You're looking for one strong currency against a weak currency, but there's nothing really, but they're all kind of in the same boat, really. So you're not quite seeing that sort of strength against a weakness. So, I mean, how would you be dealing with these sort of markets right now?
From my point of view, you have to divide between if you're an investor or if you're a trader. So as an investor, you have a completely different foundation if you want to invest in something like an economy or in currency. If you're a trader, and most of our listeners and viewers are traders, and in my opinion, or in my point of view, I'm not interested about all of this stuff what Paul or Jens is talking about, because but it's just only my opinion, because I'm not huge enough to have any kind of influence to the market. So in my opinion, this is what I always talk to my traders, is you are on the right side of the chart. No one knows what happened next on the right side of the chart. So you only can make money in two ways in trading, whatever, in British pound, for example. The one way, you are the bank always makes the money. If not, then you have to stick to rules. So the point is, all these topics like Brexit and pandemic and bars open and bars closed and all this stuffs, they have a big issue. It's a big issue, and they have a big influence to all of the traders, because we are humans, and we used to create our own opinion about the market. And the problem is, if you have an opinion, then you are completely wrong, because you cannot make money in charts with trading with your own opinion, because your account is not huge enough to have an influence to the market, to can have that your money can have an impact to the market. So I can see in British
surely there's a situation where if you can get the fundamentals line up, and from my own personal trading, if you can get what we call the narrative, right? Okay, there's some good prospects here for the UK, or some bad prospects here for the UK because of these reasons. And then if we can see that develop within, technical analysis, chart patterns, and things like that, surely that's the sweet spot, right? It's certainly the sweet spot for me, actually. I don't know about Paul and Jens there, but it gives me a bit more confidence to go ahead and be like, okay, yeah, I'm going to take a trade on this market because of these reasons. The more reasons you have, so to speak, the more you can sell the idea to yourself, and actually push the button at the end of the day. What's your take on that, Paul and Jens? So, obviously, you guys, do you just look at fundamentals, or do you wait for fundamentals to line up with the technicals? What do you do with the information that you're looking at right now?
Personally, for me, I think if I was just to look at like narrative for sterling, it's a little bit confused at the moment. It's a little bit confused from sterling. If you look at some part of it about the risk sentiment, sterling's very sensitive to risk sentiment at the moment. You look at it; it has been recently kind of weak against those Comdol currencies, against Kiwi dollar, Aussie dollar, even Canadian dollar. Okay, as they've had a little bit of a spurt, okay, over the last couple of months, right, and that's had an impact upon dollar against sterling. But then on the other side of it, weirdly, you look at the risk-off currencies of like yen, Swiss franc, and maybe an element of dollar. That they've also had a bit of an element of strength against sterling as well. So kind of sterling has had a little bit of a confused picture in terms of I don't think there's an absolutely clear narrative right this moment today. What you would look at is like on the bigger position, things like commitment of traders reports. They are particularly positioned to the short side on sterling, and I personally don't think many people in the UK, many sort of like traders, economists, would have too many issues with a weak sterling at the moment. If you remember from like the last financial crash, if you look at that, sterling and dollar weakened right just as the crash was happening, and that actually suited both the US and the UK economy to basically weaken their currencies, and that's one of the things that helped them. One of the elements of it that helped them come out of the financial crash quicker than many of the other global economies. And you'd have to say, are we repeating that? Is there an element to sort of kind of weaken and devalue the sort of sterling in order to basically make it a little bit more competitive for exports over the next, what will be a tough 6 to 24 months?
Yeah. Okay. Well, it's interesting actually, because the pound was actually starting to move lower over the past sort of few weeks. Even today actually was a pretty decent update on the British pound that we're kind of seeing. Just from a trading perspective, would you would look for a narrative in the market and then go to maybe like the technicals or like chart patterns and stuff like that? Would you look for both things to sort of align up?
For longer term trading, yeah, longer term trading, I just want to trade a dominant trend. Okay, and if there is one where the narrative, where the fundamentals, technical sentiment all line up, great, absolutely superb. But on intraday, shorter term trading, I don't really need that narrative to basically I don't really need that narrative in place. Okay, if you're trading sub 15-minute charts, the big narrative doesn't actually really have any real impact.
Yeah. Okay. And Jens, what's your take on that in terms of how you do that in terms of dealing with the fundamental information and the technical information and putting that all together?
I echo what Paul just said. This is exactly the thing. So when I look at the longer time frame, as I in fact do when I trade currencies or when I trade gold, for example, precious metal, silver, for me I really like to focus here on a longer term trends, and then also fundamentals matter, like yield differentials, for example. I think, for example, where I right now, if you ask me, what's the reason why pound was so, yeah, relatively weak, let's say, or so mixed, I think one reason could be, or at least if an investor asks me and says, hey, what do you think about this, I think it had to do with the fact that there is right now some negative yield being played by the market, so that they expect that yields could turn negative in the next 6 to 12 months in the UK. And this is probably one potential driver lower right now for pound sterling, because when looking at, let's call it the before Corona lockdown phase, it was quite hawkish to some extent. I had this impression that the Bank of England was quite hawkish in her stance in regards to the expectations of yields and interest rates, compared especially to the ECB over here. And so there was some, let's call it, room to drop here. And this is currently priced in, and probably one main reason for the relative weakness of pound sterling. But this only matters if you look at the longer time span. And also, in my opinion, it matters once you, in such events for today, so for example, this is what people like to talk about, and then what they want to get an idea on, because this is information they usually don't get in the, let's call it, mainstream media or in the news in the evening. And I think that's way more interesting than if I had to talk now about my intraday trading. That would be very, very boring for them, because I would say, yeah, well, here I'm long for this and that reason, most likely because I consider the trend to be up based on this and that indicator. Here's my stop, there's the take profit, take it from there. So 100% technical, no real connection to big fundamentals, the big picture. For example, if you ask me about equities right now, I think it's absurd what's going on there. And I think the higher we rise now, the sharper and the deeper we will drop rather sooner than later, especially when looking at developments in Tesla right now, for example. I think we will easily drop 80% if risk off hits as it did in March, and it probably even lower than that. But it does not affect my intraday trading. So right now, there would be no one, or at least not me, I wouldn't short Tesla. And I'm also playing most of the time the long side in equities. When trading the DAX, for example, I favor the long side, because this is where the advantage can be found. And this is where the money is made right now. So you can have an opinion, as Mark has already said, you can have an opinion, but the opinion, the market doesn't care about your opinion. It takes away the money from you and just leaves you standing there with empty pockets. It just doesn't answer. It's not like you can't discuss with it like with your wife or something. It just goes away, and there we go. And that's what makes markets so fascinating in my world, at least, because it's like it's a direct feedback. It's an honest feedback, and it's nothing you can discuss with, and it's just the feedback of the market in this case.
And I think we'll be remiss to talk about, British pound, and I know we briefly touched on the euro, and Paul was talking about commodity currencies. But let's face it, right? It's all about what happens with the US dollar as well. We've got to have that sort of that equation in the move as well. So, what's your take on what's happening with the US dollar right now? I mean, it's been pretty weak, really. We've seen more flows into the euro, into the pound, into the commodity currencies as well, Aussie, Kiwi, Canadian. Do you sort of see those trends sort of continuing, or is anything major coming up with the US dollar that people should be focused on?
To be honest, I'm still very, 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 very skeptical when it comes to the US dollar. And I think we see currently a very, very interesting development, in fact, which somehow contradicts this weakness we see in the US dollar, at least in my personal opinion. I'm not sure whether you followed it, but the balance sheet, the Fed balance sheet, just declined for the third week in a row, in fact. And that's mainly due to the fact that the demand for Fed dollar swap lines from foreign central banks just dropped. It was reinstated when the big volatility hit, in fact, in, I think, April. Was it May, April? I think so. It was just one line within the statement. No one, I had the if I remember right, no one really cared about this. But it was I think the big topic, in fact, because it showed that there's really big issues in global financial markets right now, and markets running out of US dollar liquidity, and banks over here in Europe, but also in the UK, also in Japan, where just they had a strong demand for the US dollar, which most likely also explains this strong rush into USD. And afterwards, we were sharply sold off when the Fed delivered, in fact. And I think the Fed has to deliver, continues to deliver. And I think yesterday, if I'm not mistaken, it was said that there's an estimate that somehow global central banks are expected to give minimum another 6 trillion within the next 12 months in liquidity to the markets, where I think, given the fact that the US dollar is still the reserve, or the reserve currency number one in the world, world reserve currency in the world, that the Fed has a major part of these 6 trillion, in fact. And given that, I think I'm very skeptical when it comes to the US dollar. So I that's somehow funny, because you asked me now about the US dollar. I was just very, very skeptical about the euro, respectively the Eurozone in general. If you ask me, I think 12 months from now, I can easily expect Euro USD to trade at around 120. So I wouldn't really want to be short Euro USD in this current environment. Still, I somehow have the feeling that pound sterling against USD is probably a better long candidate. And I somehow see more bullish momentum there building, especially once this current negative sentiment, which is surrounding the pound, is diminishing.
Okay, it's quite interesting, actually. And Marcus, before we get to you and have a look at any charts you're looking at, if you are looking at anything based on the US dollar, I mean, Paul, what's your take on the US dollar? Because I know you are, you look at the US dollar quite a bit when you were making decisions, trading the pound dollar and so on.
Yeah, so it's, I mean, if you're going to trade FX, you need to know what's going on with the dollar, don't you? Really, it's and you need to be on top of the dollar index, because pretty much all of those majors, they're just following what the dollar does. And certainly for the last couple of months, it was a real case of dollar getting sold off. All right, dollar getting sold off, and of course that had huge knock-on impacts. And as we mentioned earlier, the ComDoll's Australian dollar in particular, was doing exceptionally well against US dollar, right? And it was also, there's elements of that, of course, is that kind of proxy for China, and China was putting out news that everything was absolutely super and grand in China. There's nothing to see here. Everything's wonderful. No problems at all. And of course, you had also a rise in the price of copper, and so all of these things just gave you a great trend of basically buying Aussie and selling the US dollar. And you can look at a chart and that to see that. And literally, Aussie was great against everything. But with regards to US dollar at the moment, if you look at that kind of, I would look at that kind of short trend at the moment has taken a bit of a breather. If you look at things like the kind of 4-hour charts, I'd be looking at that. It looked like it was putting in an inverse head and shoulders. It's kind of drifted up a little bit, but not really accelerated. And I'm just kind of thinking we're at a bit of an inflection point here. If you look at some of the US indices, some of the dollar pairs, you look at even like some of the European indices, DAX, FTSE, etc. If you look at them on the kind of daily charts for the last, about 3 weeks or so, there's been a little bit of a malaise there. Yeah. A little bit of a malaise. We've been in a little bit of a consolidation, and it's almost as if we're waiting for the next bit of big news that's going to come out that's going to determine which way we take off.
Yeah.
And I think everybody's waiting to see what that's going to be. Everybody's waiting to see where to give us the decision on where we're going to go for the summer months, if we go anywhere for the summer.
Yeah, okay, that's quite interesting. And look, before we get to, I know you guys have maybe some charts you're looking at as well, just anything interesting you're looking at. Marcus, I mean, are you looking from a technical perspective, a chart perspective? Is there any US dollar currency pair even on your watch list right now for anything?
Not really. I opened a position in British pound New Zealand dollar list today, and I can see a certain strength in British pound to US dollar at the moment. So, because in my point of view, I have two things are working in trading for me. That's the price, and as Paul said, I totally agree with him. It's the trend. So, and if I have a look at the British pound USD, I can see we dropped down about the pandemic, about Corona, down to 114. And now we are on track back to 131, because at 131 in British pound USD, it's the fair price considered about the last 3 years. So now I can see a trend in British pound USD. And today we see a really strong British pound to the USD. But to be honest, Euro USD, I have the same opinion about Jens. I don't believe the Euro, because we have too many problems at the moment. But actually, everybody is focused on pandemic and on Corona. And I guess we will get really big problems. And I totally agree with Jens, because everything what's happened right now in the equity is completely absurd. That's because we are too high, and this what we can see at the moment is everything is built on paper, because we need one little fire and everything is going to be burning and it drops down. And as Jens said, the higher we climb, the deeper we'll fall. And I was waiting for that. But in Euro USD, you can see, and actually I can see in Euro USD, in daily chart, I have a fair price at 113. And we were at that point in February this year. Then we dropped down about the pandemic, about Corona, and we climbed up again. And now we are around 113. This is a fair price regarding the last 3 years. So, and I believe we will circling around this point, and it's a kind of uptrend. And I guess we will see a little bit weaker USD. But I don't believe the USD dollar at the moment. And I have a long position in USD Swiss franc.
Okay.
But I don't believe the US. It's really, Paul said it, it's really confusing at the moment about pound sterling. And last week, let me say this one again. Yes, last week, there came an interesting comment out that said we have less liquidity in the forex market, and this is a really dangerous sign, because this is the first time that I can see less liquidity in the forex market. We know the forex market is one of the biggest markets, the biggest market in general, and I guess this is a really dangerous sign, and we should be focused on rules and not opinions.
Yeah, it's interesting you bring that up actually with the volatility, because I know the JP Morgan Global Currency Volatility Index is just at all-time lows. Well, all-time lows, sorry, 14-year lows, 5-year lows. I mean, it's the volatility of the market is just very, very low right now in the forex space. And interestingly, I think it's the levels it's at right now on that index, it is calling for some sort of 10% move in the US dollar when it does tend to get to these levels. But do you think that's probably why another reason why we've maybe seen a lot more? We've just seen a lot more flow actually in indices, haven't we? We've just seen a lot more. I mean, if you look at the Nasdaq, for example, I mean, if there's just one chart you want to trade, it's just obviously it's just going to be that, right? You don't really need to. You don't even really need to talk much about it, right? With the situation that is happening there. But I mean, are you guys focused? What is your so for me, I've been much more focused, just on the indices, because that seems to be where the money is going right now. And I think that's just because in the currency market there is sort of so much uncertainty. Which country is going to be going to be the best one out of this whole coronavirus, where people want to put their money into because the economy is going to rise. It's just too uncertain to even kind of forecast that or predict that. So we are seeing a lot more flows. Well, I was saying to US, I think interestingly there, US indices we've seen a lot of divergences, haven't we? I mean, we can see the NASDAQ and the S&P are up today, the Dow is down, but European indices are just not, at these levels right now, there's just not enough momentum, is there, at this level? I mean, are you guys, I mean, I'll ask you, Marcus, I mean, are you looking at any indices right now? And I'll see what Paul and Jens, what you guys are looking at right now in terms of indices.
I'm in Nasdaq, because last week or 2 weeks ago I had a call with Marcus Koch from New York, and he said to me, "I hated what happened here right now. We hate all of us. We hate it because everybody knows it's unhealthy what we can see there. Everybody knows, but we must trade the damn trend. We have no choice." But you see, it's a kind of whatever. But I'm
Well, that's why
Nasdaq. I'm waiting for the big short.
A classic example, you know, where opinions don't matter, because all of those opinions, well, it's not going to be a V-shaped recovery. I mean, this looks pretty V to me, right? We've got a lot of indices which have this big sort of V move. But it's interesting actually, because with a lot of indices, if you look at any of the positioning data, a lot of this movement to the upside is actually it's not really from the institutional space. It's actually a lot of retail traders at home, you know, in the lockdown, you know, trading a lot more actively, which is just, you know, literally just buying whatever they can get their hands on. And you see companies which no one has heard of.
It's not that this is the first time. I think this happened already 20 years ago at the new economy bubble in 2000. I think that's not the first time, and it won't end well. And we all know this. The only question is how this is the thing, right? I think it was Keynes who once said the markets can stay way longer irrational than you can stay insolvent, or the investor can stay solvent. And I think this is a perfect way to put it. So and I 100% agree with what Marcus just said. This is really like you wait every day for the big crash to happen, and it feels so weird to some extent to be long in the market. But what do you want to do? I mean, you can short it certainly, but then the only problem is there will be a day when the market goes short, and it goes short with a big bang. The only problem will be if you shorted it over and over again on its way up, there's no money left you can short the market with then. So
when the big short is coming, you don't have any money anymore.
Yeah, exactly.
But just two things I just wanted to add to what Jitendra said. And in regards to volatility and FX, I think one main reason why volatility is so low on FX is right now, most likely I think this won't change for a very long time, is because there's a direct correlation between a yield and volatility. So if there is no yield differential between currencies, there's no reason to move in one currency and out of another, and the trend develops, and the other way around. And I think with all currency, or at least in the let's call it G8 a currency universe, with all yields being at low, there's no yield differential anymore, which means that even so-called high yield currencies as we know them, or at least we all know them, back 10 years ago, there was a high yield currency like the Kiwi dollar or like the Australian dollar. And right now they are all going the quantitative easing path here. And so first, this is the first thing. But what's now interesting, that's something I came across, but unfortunately I don't know where, but there was an article which covered the current developments in equities, which said we haven't seen such a long streak of gains, I think measured on a daily basis in the S&P, at these elevated levels of volatility measured with the VIX. Which is uncommon, because usually you see elevated levels of volatility, which means there will be down days. And currently it's only the volatility stays at an elevated level while the market keeps on rising, which perfectly fits this, let's call it retail-driven uptrend. I think it's also very thin, the whole volume we get to see, while obviously where obviously not necessarily, but that probably institutionals are buying insurance, which means they're buying volatility right now, and so they potentially prepare probably for this big crash to happen, and are right now just happy that they can sell out their portfolio at a very, very attractive price, probably even at a higher price than they would have gotten somewhere in March, to retail investors who are buying everything, not just Amazon, Google, and Apple, but also companies like Harris or Wirecard. So, and I think this, yeah, as we already pointed out, it's very, very unhealthy, and I think. Yeah, in 1 year from now, probably we'll sit together here and we will laugh about this.
See who got the big short. I mean, it's interesting because look, the Nasdaq is flying at an all-time high, well beyond its previous all-time high levels. But you know, all these other like the S&P, the Dow, the DAX. I mean, they're all trading well below their all-time highs. I mean, for me personally, I mean, I've been building long positions to these all-time high levels, and then maybe at that point, people will be like, okay, look, this is the highest we've ever been. This is just silly now, right? And maybe that could be the time people take a bit of a breather. I mean, Paul, how are you looking at indices right now?
I think sometimes we kind of we forget that we're sat here in London, Frankfurt, Berlin, Paris, etc. We're sat in Western cities, Western economies, where we've got kind of rule of law is in place, and we are actually quite comfortable. But if you're a fund manager sat in somewhere like Caracas or Buenos Aires or Jakarta or Johannesburg, the question becomes, where do you put your money? You're probably not putting your money in your national stock market. You're looking to see where would you think your money is the safest place. And at the moment, the safest money has been in the US in those particular tech stocks. And so we have just seen, a flood of money going into there that has just basically, it just creates momentum of its own, because, once a trend gets in place, well then, it always intends to, the market trends always overshoot and undershoot, and so, it's a case of you have to trade what you see. You might be able to shake your head and say this just doesn't make sense, but the reality is you have to trade what you see. So on one hand, you've got people desperate for a place to put their money, and that's clearly US tech stocks have been the way. And on the flip side, it's almost how would you describe it? I mean, it's almost a kind of a mirage, because of course these markets and these indices, they've been juiced by by effectively QE money as well, that needs to find a home and has been finding a home. So they're kind of it's like kind of pouring oil on a fire. It's effectively just it's gone wild, it's gone mad, and so you can clearly see that's represented in the in the chart. And what it does do, I think, is it just shows maybe the disconnect between the stock market and the main economy, because as you said earlier, you look at those US indices charts, that looks like a V recovery, doesn't it? You look in the price, that looks like a very clear V recovery. I don't think we've seen the V recovery in the main economy. All right, there's a real disconnect there, and that kind of comes back to the first point, is that as we all come out of lockdown, people are going to be seeing, what is the main economy going to do? Is it going to have a come back like the stock indices? And I'm sure we all hope it does. The reality is we don't actually know. We don't actually know, and so until that time, you trade what you see, and what you see is the action has been in those US indices. That's you trade what you see.
Yeah, and I think coming back to like when we were talking about the UK markets at the beginning, I mean, this thing is just
one thing, Jitan, just one question. Can I share my screen? I just came across the following, what Paul said in regards to it creates momentum on its own. That's a chart which covers the short interest in the Tesla stock, for example. And funny enough that unfortunately, I just share my screen though, that everyone can see that. Is it possible?
I don't think you're sharing it yet.
I can't. No. Yes. Probably you can give me the permission to do that.
Let's have a look.
If not, I mean, it's not a big deal. So it's just to add some paint to the charts. So the chart, I can also explain it. It's not very fascinating. It's a screenshot which shows the Tesla share shooting up, and the same time Tesla short interest as percentage of equity float dropping to okay, there we go. I think no, it's possible. Yeah, there we go. So this is from Twitter. And it shows the Tesla short interest as a percentage of equity float dropping to an all-time low, which means that most of this rally is most likely not driven by fundamentals in case of Tesla. I mean, I'm very, very careful when it comes to comparing tech stocks like Amazon or Apple or Nvidia or whatever to a stock like Tesla. Yes, I like the whole idea behind this and the vision, but still, I think this is beyond ridiculous what's happening here. But it perfectly illustrates what's currently driving the price. It's like it's the short squeeze which is happening for quite a while right now, and right now more and no short sellers are left, to be honest. So it's no one really left to short the stock, which is probably also a reason why this momentum rather sooner or later will come to an end in Tesla, and could be fueled then in regards to a sharp move on the downside once really risk off hits, because then these, let's call it unhealthy developments, are the first to be completely reversed, and probably even more than that. Just remember what happened to Bitcoin, for example. I think that was the very, I mean, Tesla is still more valuable than Bitcoin, probably, at least in my world. But you know what I'm talking about. So, what I mean is that this is perfectly illustrating where this momentum is coming from, and you just don't fight the market in this case. So this is where don't fight the trend comes from, right? So it's like there's more demand resulting out of all the people being skeptical in this case when it comes to Tesla. And by the way, I have another chart which also illustrates quite well what is currently driving the Nasdaq. I think here it's the Fangman composition, let's call it. So Facebook, Amazon, Netflix, Google, Microsoft, Apple, and Nvidia. To just put things into perspective, these 7 shares here have a market cap of over or nearly $7 trillion right now. So just to put this in perspective, Germany and Italy together had, I think it was in 2018 or so, a combined GDP of 6.1 trillion. So the biggest and I think third biggest. Italy is the third biggest economy of the Eurozone, right? So just to show how ridiculous this is, but still, this is a perfect example of why you just don't fight the trend. And if this truck takes on steam, you just don't want to try to pick dimes in front of this steamroller here. In fact, because it just washes you out of the market if you short it, if you go against the momentum.
Yeah, and I think I think another interesting thing is going to be, I think with this whole coronavirus thing happening, a lot of pressure is going to be on company finances, and maybe we're going to get a few more wire cards happening.
By the way, you're aware, we are all laughing, but I'm not sure. Are you aware of the fact that the European Banking Authority, the EBA, has prolongated it's balance manipulation, which is happening with German banks right now, or not German, but European banks. And the BaFin just allowed this balance manipulation. So if a small business, let's say, can't pay back the loan or whatever it has to pay back to a bank, the bank would usually say, okay, this is a default case. But right now, they are not putting a default sign on this small mid-sized business, but they say it's still valuable. It's just Corona based, and that's why the loans, which have already no value anymore, can be held in the balance sheets from the banks, and it's legal right now to manipulate your balance, which means, let's put it simply, under normal market conditions, usually these banks would be insolvent, would be out of business already. So we already would have had our 2008 Lehman moment, in fact. So it's very, very likely that Wirecard is just the how you say, a tip of the iceberg in this case.
Well, I wonder if it's going to be another German company, because the track record, what was it, Wirecard, Volkswagen, you know, we had Deutsche Bank as well. There's a lot of German companies that are.
What shall I say? So I will never say anything against the BaFin, but probably they have to think about their employees.
All right, so look, really interesting there in terms of indices, and look, we are having that divergence. I think Jens, you mentioned something about insurance, right? So you know, people are just, it's disbelief right now that equity markets are this high, but of course the job is not to. Job is to follow the market, right? Follow the trend, because that tells us what everyone is doing. But at the same time, you know, indices have been pushing higher. Okay, commodity currencies have been pushing higher, but we've also got gold flying higher as well. Yeah, so you know, all those traditional, you know, anyone reading a textbook or something like that on trading, you know, it's that time old correlation, isn't it? You know, gold as a safe haven. But what's your take on this, Marcus? Is it really a safe haven right now? Because I mean, it's just flying higher, but also indices are flying higher. So I mean, what's your take on? Have you been doing anything with gold actually?
Yeah, of course. I have a few at the COT report in gold, because I be aware of the fundamentals as well. Even I'm a technical trader, but I'm a swing trader. And if you're a swing trader, you have to be in focus the fundamentals as well, like seasonals or like COT report. And in gold, if you have a look at the COT report, it's extremely positioned. We have extremely short positions in the COT report, but it's less liquidity, and that's the problem. So in my opinion, it's not really a safe haven, because otherwise the markets must be so much deeper. Then it's a really interesting point. But as I said about NASDAQ, I'm waiting for the big short in gold as well, because I see in daily chart, the fair price is placed at $1,500. And now we are actually around 1,800. So, and if I combine the COE report with a fair price and with such a too expensive price, then I'm waiting for the big short in gold as well. But not yet. As Jens said, it's stupid to fight against the trend. Absolutely. And as long as everybody is buying, stand on the sideline or go with the trend. But in your back, you should know the big short must come.
Just let me know. Just let me know. I take the other side of the trade, Marcus.
He's got some big calls, Marcus. I didn't know you had it in you, actually. So, but it's going to be really interesting. But what do you? I mean, 1,500 is obviously. I mean, that's quite far away. I mean, are you thinking? I mean, what's your take on these guys? All-time highs, first of all.
In my opinion, I guess we will reach 2,000. We will reach. Markets are very predictable, especially in such currencies or in such metals and something else. Because you can see, I'm absolutely sure we will reach the 2,000 again. Then we will see a double high. But the point is, we don't trade gold, we trade the price of gold. And every price could be too high, too expensive, too cheap, or fair value. There's every kind of prices around the world. And this price is indeed absolutely too expensive. So it's a trend. And but the short must and will come, believe me.
And okay, well, I look forward to the book, right? The Big Short 2.
Did you hear that?
Of course, I write the second part.
So, by the way, what's his name? It was Paulson, the hedge fund manager with the Big Short in 2008. Yeah, he just closed his business. Is now only doing family business or a family office. He just he returned the asset under management. So
he downgraded. Yeah, I mean, there's a lot of people who, a lot of institutional players. I mean, they've not necessarily bought back into the market and things like that at these levels. But I mean, I think gold. I mean, how you guys seeing this, Paul? Because actually, I've been doing a lot of stuff on silver, because actually the historical the gold to silver price ratio is at 80-year highs, which makes silver very, very cheap relative to the gold price, which is actually why we've seen even in silver prices, we've seen a big push higher. I mean, it's not as the trend isn't as clean, of course, as gold, as this chart slowly creeps in. But are you doing anything on commodity markets, Paul?
I think definitely looking at gold. I think I might have mentioned this at the last roundtables. I have like positions in gold for my SIP, my personal pension. Have done for the last couple of years, and my own view would be that the kind of easy money has been made in gold, all right, over the last 2 years. We really trended up nicely from around about that kind of 1180 area up to what was up to about 1780, all right. But at the moment now, I would tentatively agree with Marcus in the sense that I could see us drifting towards 2000. I don't know if I wouldn't nail it on, because invariably the moment you nail it on is invariably the moment it's about to turn against you. But I could see it drifting up there, certainly towards those highs we saw. We're already getting there. Those highs from what was about 9 years ago, sort of about 9-10 years ago. I can see us drifting back up there. And then it's a case of, well, what's the market going to do? Once it gets back up to those levels, then I'd be looking to say, well, what does price tell me? And it might well be that it goes up there, takes up some orders, and then rolls over and falls away. And if it does that, well, then I'll happily short it all day long. But once again, I wouldn't be looking to fight that at the moment. It doesn't look to me like that gold trend is over. I'd just say the easy money's been made in it. That's all.
Okay. So look, before we wrap up here, guys, I did have there was a question from someone here just in the group. So Lauren Chu, quite a few questions here, so apologies if we don't answer all of them, but what is the reason for the UK to leave the EU? So I think that's going to be a personal one, right? I think everyone's got a different opinion on that one, and there's lots of divisiveness.
I think it was Asterix who said that the Brits are crazy or so. I'm not sure. I was just
this little town.
A small little country, yeah. But I think that's going to be a personal one, right? So it is going to be interesting. I mean, I think with obviously Brexit coming up and the impact that can have, but there's also the great thing about trading, and obviously one of the benefits, obviously, with admiral markets is that you don't have to be forced into one market, right? You can scour the earth, right? And find the right price, find the right patterns, find the right narrative, whatever you guys are looking for, and actually participate, whether that's, currencies, exotic currency. So I know Jens, you were talking a little bit before about a yield differential. So a lot of money tends to flow into currencies which have higher interest rates than lower interest rates. And that's pretty much what you're sort of getting in those Russian rubles and other exotic type currencies. So I think that's one of the benefits right now, isn't it? Is that people can look around. You can shop around, so to speak, right? To find the right price, to find the right market, whether it's currencies, indices, commodities, individual stocks. So I think having that access to that multi-asset class trading platform is just, I think in these kind of market conditions, it's just so important, right? Because if you're just trading FX, historical low volatility, you're missing out on everything on indices, right? And then you might even miss out everything that happened on oil before that, and individual stocks that you've been talking about.